Welcome back to the Legacy Lounge a year later for part two or take two of the last year in review. How you feeling?
Oh, Deborah, thank you for having me back in the Legacy Lounge. What a year, right? We've just had this amazing journey together that we're embarked on and really didn't know where we were going to go. And I think we've gotten to know each other pretty well, I think, over the last year. And I think that journey is moving in a direction that I think we're both excited about.
And through 2025, we've seen a market as low as 4,800, as high as 7,000. We've seen tariffs and Greenland and immigration issues and massive tax stimulation from the administration. And the market kind of keeps chugging, almost as if nothing happened. But there's been a lot going on as a firm. We've built our platform, we've built our team, we've built a culture of care, both in and outside of the firm. And we've built a great partnership, and it is just such a joy to work with you. As we look back at 2025, what are some key takeaways for you for the ride we've had over the last year?
Oh, well, thank you, Deb, for having me in the lounge again. And I share that word joy because I think that's exactly a year later the way I would express what we've done together. And I think there's a vision that you had for the firm that we shared very early in the way that we thought about how we'd want to build a firm together. And I want to thank you because I think that you've built an environment where we can foster that culture and create that vision. So thank you. And I think we've done so much in this last year, and I'm just really, really excited about some of the investment side things we've done, some of the things on the planning side, but most importantly, how we've tried to put it all together, which is really the most important part of what we've been trying to do and what we both understood as the mission. And the mission is to give the client that experience, that client focus. And so, I wanted to almost turn it back to you because we've been having these conversations all year about where we want to go and how we want to build this firm. So I want to sort of talk through like how you've been thinking and seeing this planning process and how how the integration with what we're doing on the investment side looks from your end.
I think you shed a light on integration very early on when you came. And I think a lot of firms have the investment guy or gal in that department, and then they have maybe insurance way over there and planning. And you understood immediately the importance of integration and how companies shouldn't provide services in different lines of services where people don't talk to each other or there isn't incredible cohesiveness and coordination. I mean, in order for a family to have a great investment plan, they need to have a financial plan that the investment specialist understands. And you understood from the get-go. And I think it has had more meaning even for me, even though that's the way I've lived my whole life and tried to make the other firms. I think you can take a lot of credit for shining a light on that. It's really great.
No, I appreciate that, and it was something we talked about. I think early on too was this idea that it just didn't make sense, like to not think of. And I think we've started to talk about this in different ways. Of it's assets under management is one aspect of this, but if you're really building the firm and the relationship with a client the right way, it's a relationship, not just an asset. And I think that's something that is, I think, so important to both of us in the way that we build these connections to our clients, in the way that saying there is a financial aspect to the decision, to all the decisions we make, but there's also a life aspect to it, or how it fits with what your legacy is as a family.
As a family. Well, and I think, we've talked about the fact that we begin every engagement with a financial planning contract, that the next step is the vision and values interview. And even though money is a piece of paper, it's an inanimate object, but people assign such different purpose and emotion, even in some cases, to money. And you've sat through the vision and values, and I know that in that meeting, clients can make decisions in real time because they're, for the first time, really tying their money and the purpose. And it also, with family retreats, has the opportunity to align families in that whole experience. And so, beginning that way, and then you coming in with, having that knowledge and having sat in those meetings most of the time, putting an investment plan together and portfolios together the way you do in a very customized way, it has been a major add to the firm. And your experience is just incredible. And if we have a chance, I'm sure I'm going to pick at it in a good way as we talk, because you bring so much experience and depth to the firm.
No, and I think that that's a really important part of this, is that idea of goals and objectives, right? And that we're ultimately thinking about, the world in terms of goals and objectives, whether it's the legacy of the family, or the investment decisions we're making, or the planning we're doing, or the estate planning that we're facilitating. All of that has to do with what does the client need. And I think that that's where, from the investment perspective, it's so easy as an investment manager to think of things in terms of benchmarks, or you think in terms of indices, or think I'm trying to beat this. And we are all trying to beat them. There's no question we're trying to do it all the time. But at the end of the day, what's the purpose, right? The purpose is to pay for something, or to be able to experience something. And so those are the things that's where that segregation, as we talked about, didn't really make much sense to me when you didn't have it all put together in that integrated way. And so, that's really what, the investment platform, we talked about it in theory last year. We now put it into practice. And I think that that's what's been really something that I've been able to take from those vision and values meetings and from the financial planning meetings, and say, here's how we translate that into your portfolio, the constructed portfolio that makes sense for whatever your life goal is.
Mm-hmm. Well, and I think the combination of our experience has dovetailed so well. If I look at, the fact that chemical engineer by background, and then you started doing analysis for portfolios and working at major companies, but especially the experience you had working with a family office, where you had the opportunity not to work just with public investments, but also look at a lot of alternatives. You were constantly vetting them for families. And we'll talk more about that later, but it really has helped us provide a full suite. And we'll talk about why I think we're different in private a little bit later. But I guess the other thing that comes to mind when we talk about integration is efficiency. There's so much discussed about efficiency, and a lot of times people think about efficiency meaning AI and technology. But I think a lot of large companies think about it as scale. Make the task quicker, shorter, take less time for everything. And I think that in some ways has caused firms to walk away from in-depth planning, especially estate planning, because it takes such expertise and it takes such time to really talk about a family, about their legacy. And it turns out that our focus is really much more, we want to be efficient, but the focus is much more about effectiveness than efficient. Some of the things that clients value the most are not that efficient. Try to do a family retreat with 12 people and be really efficient about right. managing those relationships. The clients value that. And I'm so glad that you buy in to all that, because it's so easy to think that the answer to everything is scale. some things just don't scale that well.
Oh, that's it's so true, Deborah. And I think that's one of the things that I've always thought that you've got to figure out how to use some of these tools like AI and technology and some of these things to make the experience better, not to necessarily always make things faster or make them more let's say model driven, which in an investment world
It's the sameness.
there's a sameness which makes it that's easy, but it doesn't fit necessarily with a goal or an objective. And so if you're trying to customization is a lot harder if you're not listening and you're not having that actual human touch. And the human touch, by definition, is not necessarily going to be the absolute most efficient way to operate, but at the same time, it informs it at such a level that it improves the outcome.
It's a deeper,
deeper
more
understanding.
profound outcome for the family.
That's right. And I mean, that's exactly where, we think about, I mean, from the investment perspective, I mean, we have these, what we call our models, right, but that we use, but they're very, part of the beauty of what they are is that they're very active. Most of the models that you see out there are typically using a lot of the passive investments, which is, by definition, you're owning an index or you're owning a series of indices. And when you use active management and you actively using active managers who are making decisions on every piece of the portfolio and then putting them together in a way that creates a specific outcome, you do a lot of different things, but the most important two things are, one, you can manage risk much better, and you can also capture opportunity much better. And sometimes people don't see that those go hand in hand. Sometimes it's a you're giving up one to get the other, but in reality, that active management actually can give you both. And I think I think we've talked about this before. Passive, as I always say, passive investing is not really so passive, right? And we will, I'm sure we'll talk more about that.
It's an active choice.
It's an active
to
choice.
be passive. And now with, the top stocks being 41% versus 31% last year in the S&P, I think a lot of people aren't aware of the risks that they're taking. So what a lot of people are doing with the index funds to be clever is to have a tax overlay. They've got the index fund, but they're using a tax overlay on it. And that takes away from some of the customization. That does take more time. But there are opportunities out there where you can have your cake and eat it too. You can have customized portfolio and tax overlays. Can you speak to that a little bit?
Yeah, I think one of the things that we've found is that the idea of tax overlay is something that has been around in other corners of the market, more on the institutional side, where if you're
For a long
managing
time.
for a long time,
Yeah.
if you're liability driven investing, or if you're a hedge fund, or you are thinking about the tax implications of what you're doing, these vehicles were running their portfolios in this way. I think what's happened, with partly because of technology and partly because of a need within the market from clients to say, well, we need these kinds of solutions. Can they be created in a way that can be used by every client? It started with the direct indexing that we all know or are familiar with, where you take your S&P 500 index, you deconstruct it into its component parts, you trade it, and you try to tax manage that in those individual parts. It's a step in the direction of more efficient tax planning, but what you're missing in that is, what if you could add the layer of long short, where you say, well, if the market's up or down, I can take advantage of those opportunities. And then what if you could do that where you can hold your own portfolio and layer that strategy on top of it, and then you can customize the portfolio to the client's needs. So I think you've just seen this evolution that we're very much embracing, because we understand one aspect of this is that this is a situation where scale has actually allowed for more customization. And I think in this case, we've got some real opportunity
Is a
to
great
benefit
example, isn't it, where
the clients.
AI not only created scale, but it gave all this customization, even allowing for concentrated stock positions. So it has really been, and we've been told that we were really on the leading edge in that area, and that there really aren't a lot of products out there, but we've been able to identify them, and I think that that's been a real coup for our clients.
Yeah, and I think, we now have the benefit of a year of experience with our
Right.
clients, with some of these strategies, with our strategies on the public side, with our strategies on the private side. And, I think the underlying, if you were to say, what's the one line that defines what we do? And I think it's that we've said this before, but it's diversification with purpose. And I think that encapsulates a lot of what we do, because if you're thinking about diversification with purpose, that means every single thing that you put in the portfolio, there's a reason for it. And that reason might be to reduce risk. That reason might be to gain opportunity. That reason might be to get more exposure to a certain factor, value, growth, momentum, whatever it might be. It might be to lower your exposure to something. There's so many different ways to think about that, but I think diversification is a tool to manage that risk opportunity balance that we're always trying to just get right, so that we can create that all weather type of portfolio where we're not so worried about the latest machinations of what might be happening, because we're seeing a lot of geopolitical shifts over the last year,
Absolutely.
like we haven't seen in a very long time. And so in to try to minimize the reliance on predicting those things successfully, let's create portfolios that can be run through those environments and be able to manage through all of these kinds of risks.
Be durable portfolios that are, I mean, everyone would like to have an all-weather portfolio, but really you need to have things inside the portfolio that are behaving very differently. And that has been, I think, the best I've done in my career with your guidance of, attracting a nice return, but also capturing less of the downside, and really having some negative correlations in the portfolio. They're so hard to find.
Yeah, and that's what's so interesting, right? Is that we always think of correlation in terms of, or many times think of correlation as asset class driven. I want to own a 60-40 portfolio because stocks and bonds don't normally move together. But in reality, they actually do move together. They just don't necessarily move as much in the same direction.
Yeah.
So you're not really getting that, what you just described is exactly the anti-correlation, or when something goes up, does something else go down? Like, can we actually create that balance? And I think that is created through not just asset class decisions, but it's style decisions, it's time horizon decisions, it's geographic decisions, it's currency decisions. And all of these have to be integrated in the portfolio. And that complexity, we rely on some of these managers who we've identified that have real expertise in some of these areas, and then put them all together in the way that we think is most optimal. And ultimately that creates this, that's what creates the all-weather, is true diversification across so many different elements, rather than just diversification across 1, 2, 3 elements.
And I truly believe that your experience with family office and your experience having created a successful hedge fund yourself and running that is a real cornerstone of our success. So,
Yeah, I mean the experience of both of those actually really has been a big reason why I think about investing the way I do. Because coming into those two environments, I had a pretty traditional career of mostly long-only equity. So I was looking at stocks. I was looking at stocks in certain sectors. Started out in chemicals, which in chemicals you can very much map out supply-demand a lot easier, because it takes time for plants to be built and run. And so you can say, here's when the supply curve is going to look like this, and here's what demand's going to look like. But as you move along and you start to realize there's a lot more complexity to investing, there's a lot more complexity to each company, and then you start to run your own fund and run, especially when you're going long short, you realize there's not just one factor that's driving everything. There's a lot of factors. And so then you need to say, how am I going to optimize understanding as many of these factors as I can, or find expertise that does have that expertise and integrate it into the thought process of what we're doing. But then adding that into the family office of putting that together with the optionality of putting privates into the portfolio. And then that just changes the equation in a lot of different ways to think about, what exactly does a family need when you have every investment open to you and you want to create this legacy. And so that really informed from purely an investing decision to a more investing/planning decision.
Right, a fully integrated, and by the way, it captures our mission of,
Right.
of accumulating or growing and preserving wealth. And we take that preserving wealth. People didn't hire us to work their entire lifetime to have a comfortable financial situation and then have us come in and take too much risk. So, I mean, we're true to that mission. In integration, we talked a little bit about the vision and values. The estate planning piece, I want to spend time on, because what's happened in products and what's happened in investments is even informing what we're doing in legacy planning and multi-generational planning. And again, a lot of firms they're good about being passive and responding to questions that clients have. But doing what we do, audits of the legal documents, audits of life insurance policies, and looking at the estate planning in a very integrated way with the plan is something that I think a lot of large firms are running away from, again, because they can't scale it. And AI is helpful, and we've looked at everything there is in the estate planning area, but there are still gaps that only humans can fill in. And our commitment to integration is not just on the planning and on the investments in the area of insurance, where it may be the cheapest way to pay the tax, or with private placement life insurance, which is multi-generational. It's a perfect vehicle for patient capital.
Yeah, I mean, and that's the piece that people forget, that insurance is an investment decision.
It's just an alternative investment.
It's an alternative investment, and I think that's where we think about that maybe a little bit differently, where it's considered maybe a separate product or a part of planning, purely a part of planning. But again, since we're putting planning and investing and insurance and all of the pieces together, when you put all of them together, you realize insurance turns out to be maybe one of the best ways to leverage legacy, right? Where you can say, I'm going to use this dollar amount to be able to give this much to future generations. And it can be a planning mechanism in terms of tax planning and other things as well, which again is more to your to your future generations.
It's transformative for the next generation, and it's the most unselfish planning you can do, because you may not see the benefit of it while you're alive, but what you transition is meaningful. And our commitment to not only the CFP in financial planning, but it's our belief that if you're going to service and even procure life insurance products for clients, that you need to have a Series 7, and you need to have a life insurance license, and you need to stay current with products and do the continuing education. And that's been a problem for some of the large companies, because if you do that, you have to respond to two regulatory bodies, the SEC on investments and FINRA on insurance. And it means double licensing, and it's not always that easy, particularly as you get large. And if you've got 1,000 advisors across the country, some larger companies have just made the decision that they don't want to go that route. But then estate planning becomes something that gets lost, and it's not fully integrated with the plan.
Yeah, and to that point you were making earlier about efficiency versus effectiveness, it's more efficient to not do all of those things, right? It's more efficient, not necessarily to plan,
You're right.
but it's much more effective to
For the client.
for the client. And at the end of the day, that's where we really want to focus that our attention on this idea of that the efficiency side. You want to be efficient. So many people say, well, I don't want to have to deal with two regulators. It's because that's inefficient. Well, we have an in-house compliance department. We'll be happy to do that because we know that it's going to give the clients a better experience. And so that's something that's really important to us, and an important reason that the integrated, the way that we're integrating
Holistic,
and holistic.
integrated planning.
Yes.
And you can't be as efficient with some relationships and family retreats and so forth, and you can't be as efficient when you're talking about a legacy. It takes time. I had one client say, boy, you spend too much time with me, and I'm so glad you do.
That's right.
Because we're really getting things done.
Well, and that's exactly, we talk about this all the time. We want to be the family office to any of our clients, right? That doesn't matter what your asset level is. So I'm sure there's a lot of clients that might be surprised at how much time we both spend with them, but we do believe that every
Right.
single client is a relationship that's a family office, regardless of whether they have $1 billion or 10 million or $1 million, right? And or 5 million.
And
so.
I've had two firms. I'm fortunate to have owned and operated a couple of firms before setting up this firm, and I'd like to think that success leaves some clues. But I didn't establish this firm to be the same. Having said that, we have all of the licensing and all of the continuing education requirements. We respond, and we've done that for 40 years. I've done that for 40 years. You came in and were willing to understand it and work with it and not like and embrace it. Really, I'm so grateful. But I think we're really on to not just the same thing I did before, but the next great, best RIA. And
yeah, no, I share that, because I think that one of the things that we've seen, and you have, this depth of experience within the RIA community to know what you could and couldn't do in the past, or what you had either limitations on, or where you were ready to make a jump into. And I think we're at a place where we're open to anything, and I think our independence allows that. That independence allows us to look at all kinds of different options, be open to all the different options,
be nimble.
We
We can change quickly if we think something can be done. We use AI. If we think it can be done faster, more efficiently in terms of the process, we do it.
That's right.
And we can make the decision right here.
That's right. We sit and we decide that, say, you know what, maybe we should be. And a good example is like what we're doing on the private side. And I think one of the most exciting things that I think we've undertaken is this vision that we're calling the Texas Collective. And I think the collective is great because it goes back to that first thing that I mentioned about risk and opportunity. Right? When you're sitting and looking at an investment, those are the two pieces that you want to pay the most attention to. Well, what I've found is that what we've seen across the investment industry is this push into privates for the average investor, which I believe is great, because it's something that everybody should have some level of access to. The issue is that we're getting access to these things through vehicles that often look a lot like maybe exposure vehicles. Meaning, what I mean is it's like an index fund. So you say, I want to get exposure to the stock market. I buy the S&P 500. I get exposure to private equity. I'm going to buy a very, very large private equity fund that's been around, that has done a great job for many years, and most people should be can be comfortable investing in. But is that the best opportunity for the client? And is that the best opportunity that you're capturing by giving up some of the liquidity? Because you're giving up liquidity when you invest in privates. So if
And
you're
you would
going
only do that for a greater opportunity.
Exactly. And
You'd
so
only
if you
take more risk for a better opportunity.
And so you'll take more risk, but then say, so how do I take more risk, get that opportunity, but also reduce the risk because that's part of what we do. We want to make sure that if we're going to do that, we're going to do it in the way that we think is best suited to the risk reward that we're trying to build. And so what we've put together is these 5 investments initially, and there'll be more as time goes on, that span, VC, they span private equity, and where we see opportunity in private credit, where, maybe broadly, there may be some challenges within the private credit market, depending on where you sit. But the way we look at private credit, we say, oh, let's find a corner that we think is a lot less risky. And so we pick, certain areas of things like litigation finance or something in that area.
Litigation finance where the suit has already been won.
Right.
So you're just in the settlement phase. You're not trying to guess if the suit is if it's going to win or lose. You're not betting on the attorney or the outcome. But there's a period of time where it just takes 3 years to settle those large cases. And the yields are very attractive.
Yeah, to us, that is a way to get exposure to private debt, but in a way that's much more secure and we have much more visibility into. And similarly, when we talk about private equity, the 2 investments that we've currently are using, one is focused on orphan energy assets, where thematically we believe in energy as a theme. I think this is a common theme that's out there because of AI. I think people are hearing about this a lot, where we're going to need a lot more power. And so energy...
Yeah, 50% of the demand for energy is now attributable to AI.
I mean, it's remarkable, like how much... And most of the construction that's related to any sort of power plants is all AI driven.
Data centers.
It's all because of the data centers.
Yeah.
And so we have an energy company, an energy fund that's focused on, let's say, orphaned assets. So assets that maybe the larger firms are like our large energy company may not see as strategic anymore. So there may be an opportunity there, but it's part of the bigger theme. Mm-hmm. And within private equity, there's a whole theme around sports, which we've talked about in other podcasts with some of our other guests as well. But the sports theme is something that's resilient, it's cash flow, it's tax advantaged. So it's not just buying private equity to buy private equity, it's buying very specific curated private equity. And then lastly, on our VC, in one sense, we're very focused on a theme of consumer products, specifically around female founders, which we think, again, is a unique corner of the market. And then the other is technology focused.
Before you go there, there is some pretty good evidence that for every dollar invested, these women-founded VC firms are actually delivering more per dollar, a higher return than their male counterparts. And, I'm not male bashing here at all, but I do think, it's one good one for the gals. And they do make 85% of the buying decisions in the home. And so why not be a founder in terms of identifying the best products that you're going to use? So I'm very excited about the consumer product goods that we have an expert in that area.
Yeah, and I think that's a really important point, is that it's something that is kind of maybe not well known, is that the experience of those female-founded companies and the female-founded venture managers has actually been very, very good. And so, many people think of it, sometimes it's similarly like when you're investing in the public markets and you have checkbox, I need to have a little bit of small cap, a little bit of large cap, a little bit of this, a little bit of that. Some people say, okay, I need to have something that's related to consumer products with female-founded consumer products. That's not what we're doing, and that's not the way we think about it at all, because it's a good business decision, right? It's a good investment decision. Right. So and on top of it, it's an underserved investment decision, which creates even more opportunity. The opportunity gap is much wider. Mm-hmm. And so I think we're really excited on that side. And then to add to that VC, we have another group that is focused on technology within space, medicine, and energy, so they basically create this nexus in Houston that we have, and the technology that enables those 3 industries they're at the forefront of that. And so we're just really excited because in those cases too, again, for the way we think about privates is if we're going to invest in them, we want to have a little bit more understanding of what's being put into the portfolios. So in some cases, we're actually on investment committees of some of these firms.
Or the portfolio advisory committee, where we're sitting down with the founders of those companies.
Exactly. And so that way, as a fiduciary, we actually have a much better understanding of what we're putting into our clients' portfolios. So that goes back to the risk part, where we are not only getting these great opportunities that we expect to have strong returns in the future, but we also expect that we're managing the risk because of what we're doing on the due diligence side.
Yeah, these smaller outsized returns are a good potential. We know that 20 years ago there were 8,000 stocks, and now there's just over 4,000 traded stocks, and so people are looking to the private markets, but sometimes there's a rush to things and maybe not as much curation of the decision. And I think your experience in having looked at those for a long time and us being, the nexus of Texas with space, health sciences, and energy, as you said.
And
that's exciting to me. So that's why the
absolutely.
Texas Collective is exciting to me.
Yes, and when we say Texas Collective, it's really exciting because it's all of this intellectual capital that we see in our state. Right? We see these amazing founders, amazing managers that are finding great opportunities all around the U.S. and in some cases globally that can transform the economy, transform industries, and we're trying to get into these at an earlier stage in some cases, or even in the growth stage. So we're kind of investing in early stage, growth stage, and then when you talk about something like litigation finance, it's pretty later stage where we're pretty confident that the returns are there and it's relatively short duration capital and we're going to get a nice return. So we kind of look at this entire spectrum and say, how do we make sure that we get exposure to the risks in the right way and still get the returns that are that our clients need to again meet their objectives.
Yeah, I think it's really exciting because there's so much intellectual capital on private VC in Houston, and yet they invest in companies across the nation, maybe even globally, as you said. So it's pretty exciting because a lot of eyes are on Texas in terms of what's coming out of our state. And Houston is, we're the third largest city in the country now. Just surpassed.
Yeah, and it is, and our migration. You're seeing the migration,
positive migration,
positive migration that's coming into the state, which is adding more talent, and that's a big part of this too. Is we're not only having all of these companies come here, but we're attracting the best and the brightest, and that creates this. We've been excited because there's a real buzz around Texas, right? In our minds. And of course, we're to some people's extent we're homebodies, so we're going to say good things about Houston all the time, but it's real. We're seeing it, and I lived in New York for some period of my life too, and coming back to Houston, I think this might be some of the most exciting times that I've seen in my career, and since living here of just the changes that we're seeing and how rapidly it's happening.
Only in America can you also experience this kind of excitement, and then to be able to start new companies, new ventures. As I was saying, I don't want this to be the same. I want it to be a better experience for clients, and we're probably a great firm for a family that was thinking about starting a family office, but then they look at all of the expenses and potential turnover of people that they hire, and they've just gone from selling a business in some cases to starting a new business as a family office because it's running a business day to day. And so we're pretty good solution for those families, who would rather not make that expense, but need somebody who runs very wide on planning, investments, and alternatives, including insurance. And we've only just begun a year in, but after a couple of firms, I think the thing now is for this to be the next best business model. And, when you start a business, every single time you start, you can't believe how much work it is. And you can't believe, that you're doing it again. I think it's kind of like for a woman, it's like labor. You have that child, and the joy of the child makes you block the pain. So you just become a serial entrepreneur because you forget the pain. But then you look what you've got. New technology that we can apply. We're not strapped by any old tech. We're not strapped by any old investment models. We can do our own. We can make the decisions. And I think clients like sitting down at a table when they know that the people that are at the table are the ones making the decision. They're not sending it off to a home office or getting an investment committee with a bunch of people they don't know putting their portfolio together.
Yeah, and I think that adding to that too is that the width is so important because we can do a breadth of things, and at the same time go deep, because we have the experience in the room between this entire team that we have at Stavis to be able to go deeper into your wealth of knowledge in planning and insurance. Some of my experience on the investment side that's now multi-layered.
Your network. I didn't mean to. I'm sorry to speak over, but to never forget that you've worked at major companies. I mean, your experience at Franklin Templeton for 7 years before you came on global investing and strategic investing, the family office, the engineering background. I mean, that brings so much to the table, and there's nothing to strap us or hold us down because we can make the decisions about the best client experience. So I'm always thinking, if people ever liked any of my former firms, like Stavis and Cohen, they're going to love Stavis Wealth because we have so much to offer, and I'm having a really good time, and I hope you are too.
No, I mean that's exactly. I think what's come out of the last year the most is, I think, how much we enjoy this journey together, because I think we are seeing just how much impact we can have if the tethers are off, right? We're both free to do exactly what we think is in the best interest of the client. Just give us the tools.
With a lot of experience,
right,
and a great network of specialists who are informing us more every single day. A colleague of ours, in speaking about, just getting better as people and better, says that AI is not going to replace people, but the people who, don't know AI may be replaced. And so we're doing everything we can from a tech and efficiency standpoint, but we're never going to lose that human touch because we understand that there's value even in inefficiency.
Absolutely. I think that's a great place for us to stop. I think that's because that's exactly what it is that we are, there's a level of wanting to have these dialogues with our clients, right? This idea of spending time, right? I mean, I think that's
spending time aligning families, aligning them with their goals. And so I look forward to many more years.
Yes, looking forward to it as well.
Thanks, Samir.
Thanks.